Welcome back to the last panel of the day. In the first panel, we looked a little bit at the specifics of the market at the moment and the current issues and current conditions. I'd like now to be a little bit more forward-looking and look at perhaps prospects for covered bonds and their alternatives, such as mortgage finance agencies in the Asian region in forthcoming years. And in particular, what the covered bond market can do to help development needs in some of the countries in the region. To help me do this, we have the panelists you see in front of you. Colin Chen is one of the most familiar names in the covered bond market, a long-time supporter of covered bonds in Singapore and the region. He's Managing Director and Head of Structured Debt Solutions and Co-Head of Financial Institutions and Structured Products at DBS Bank. And also, I think crucially for today's discussion, he is in charge of the ECBC's Global Issues Working Group, so has a much broader remit than just Singapore. Joe Wong, Vice President and Senior Analyst at Moody's Investor Services, is the rating analyst for Asian structured finance products. In that role, he's been responsible for, I think, most of the Singaporean and Korean covered bond programs that have come live. And last but not least, and I'd like to start with, Datuk Chung Chi Long, the President and CEO of Kagamas Berhad. Kagamas Berhad, as you know, is perhaps one of the most established of the international mortgage agencies. And as such, Datuk Chung is also the chairman of the International Secondary Mortgage Market Association, a body which aggregates these agencies in different countries. So if I can start with you, please. Kagamas, all mortgage finance agencies are slightly different. Kagamas Berhad, very well established, very large, quite unusual in offering both recourse products and non-recourse products, so equivalent to pooled securitizations and pooled covered bonds. Why do you offer both of those products?
Thank you, Richard. Kagamas was established 35 years ago with the primary objective of promoting home ownership in Malaysia. Now, I think at the time when Kagamas was established, there was a huge maturity mismatch between deposits and the housing loan tenor. So as a result, there was a need for an intermediary like Kagamas. However, having said that, banks were quite reluctant, even at the time, to offload the loans from their balance sheet. Everyone wants to grow bigger and bigger. So as a result of this, I think in the discussion between Bank Negara, our central bank, the banks and Kagamas, I think we developed a pseudo securitization product, which is basically the purchase with recourse. Now, purchase with recourse is really like a repo, a liquidity facilities to help banks basically in securing longer term financing or funding from the capital market through Kagamas itself. So essentially, Kagamas takes on the counterparty risk, or the bank continue to keep those loans on the balance sheet and they take on the credit risk. So that's why basically for the last 35 years, since the establishment, the purchase with recourse is actually one of the main products in Kagamas itself. Sometime in 2004, basically Kagamas also then undertook the purchase without recourse facilities, which means we take on the credit risk, we take the loans off the balance sheet of the originating institutions. In these cases, basically Kagamas will take on all the credit risks. And we could securitize this under our residential mortgage-backed securitization in 2004. However, when the global financial crisis came in, investors were actually quite reluctant to continue investing in the residential mortgage-backed securities. As a result of that, basically then Kagamas continued to purchase these loans even with recourse and without recourse. And for those which are without recourse, Kagamas continue to fund them under the senior unsecured. So if you look at Kagamas' balance sheet today, you look basically on the asset side. We have got exposures to banks which are against collateralized against loans, mortgages particularly, and as well as loans itself or mortgages that we have purchased directly from the originating institution. On the liability side is basically the bonds and the sukuk that we have issued. So in essence, Chagamas, if you look at the balance sheet, is really a big covered bond because whatever issuances of bonds and sukuk we have in the market, it is always backed by a pool of similar amount of loans that we have purchased from the institution. So I guess in the last 35 years until today, Chagamas have actually issued a total of 366 billion ringgit worth of bonds and sukuk in the market. And this basically has been the model that we've been doing in this last 35 years. And I think the World Bank has actually recognized Chagamas as one of the most successful liquidity, a secondary mortgage liquidity facility. So I hope that answers your question. Basically, I think it's out of the needs of the market at the time where banks were reluctant to sell. So that's why we come up with this liquidity facility or the purchase with recourse, or what is actually akin to a repo. Thank you.
Thank you. And very roughly, what proportion now are with recourse and what percentage are without recourse?
I think it is currently about 80-20, 80 with recourse and 20 without recourse in as far as the outstanding in the balance sheet is concerned. So as I have mentioned, banks have continued to be quite reluctant to offload their mortgages from the balance sheet. But I'm not sure, but basically in Asia, you see the tendency is to say the bigger is better and prettier. So basically, I think as a result of that, banks are generally reluctant to sell loans off their balance sheet, but they are keen to avail to the liquidity facility that is provided under the purchase with recourse program.
Another interesting feature, that a successful feature, you mentioned already your central bank's role in setting you up, and I believe your central bank still owns 20% of your shares, but you are mixed, public and private. If I look around the world, in Canada, it's 100% private owned. In Norway, it's 100% public owned. In Norway, it's the opposite. It's 100% private sector owned, the mortgage aggregator. It's relatively unusual to be both public and private. What are the advantages, and if I can, what are the risks of that approach?
I guess when the idea of setting up Chagamas started in 1986, I think there was a need to look at a public-private partnership at the time. The benefit of public-private partnership, it actually gives stronger governance. It gives a diversity in terms of perspective to both the company as well as the various stakeholders. So when Chagamas was in the infancy stage, basically you see that the shareholders, meaning the banks, the central bank, and everybody would work together to ensure the success of Chagamas, for example, and to ensure that the mandate of promoting home ownership among Malaysians happen, as well as also to promote the capital market in Malaysia, which was at its infancy stage. So I think a public-private partnership actually gives, to a great extent, a good blend, a mix of experience, expertise, as well as deliberation at the board level, I guess, between central bank, which represents the government, as well as the other stakeholders. Now, having said that, although we are just 20% owned by the central bank, basically, three of our largest banks have also basically got huge shareholdings from the government. So indirectly, Chagamas also actually own about 40% of our effective ownership is actually by the government itself. So in essence, it is a good model, I would say, that to have a public-private partnership, although obviously there are pros and cons of either way. So I guess we have the best of both sides.
And one final comment, if I can. It's obviously, as you say, the World Bank recognises it's a very successful model, but this is a covered bond session. To what extent does Malaysia need covered bonds as well as Chagamas? Or is there a conflict? Is Malaysia doing anything to develop more traditional covered bonds, like in, for example, Singapore?
Well, first of all, I think at the moment, the Central Bank of Malaysia has not come up with any guideline any regulatory guidance with regards to issuance of covered bond in Malaysia. And also, I think when we speak to the banks, the need of them to offload the risk is somewhat not as critical at this point in time. And also from the investor's perspective, issues like Chagamas and other AAA banks, for example, we are considered expensive by the investors. So when we do covered bonds, and if we do covered bonds, obviously yields will even be tighter. And obviously it may not be attractive to these investors. Now, having said that, from a developmental perspective, we are always looking at the chance of looking at whether we could issue covered bond, for example. But we also need to look at the economic aspect of it. So, for example, in countries where there's the Mortgage Refinance Corporation, like in the US, for example, Fannie Mae, Freddie Mac, and you have in Malaysia, just as another example, Chagamas, isn't that the presence of the Mortgage Refinance Corporation may somewhat defer the urgency of perhaps the development of covered bonds. Simply because it is quite similar, okay? When the banks need liquidity, instead of going into the market and issue covered bond themselves, which probably will take a few months, or at least 1 month, I believe, or more, because you need the rating and you need a lot of infrastructure to be put in place. Whereas if you come to an MRC like Chagamas, you only need 7 days at the most. You can even do a 5 to 7 days. Basically, you will get your liquidity within that period. And I think in terms of cost-wise, I would think it's actually much cheaper for the banks to actually come to Chagamas, for example, to sell their loans under the purchase with recourse program, rather than going into the market themselves to issue cover bond, as an example. Now, mortgage assets is a very valuable, I think, asset class for most financial institutions. It is perhaps the safest asset class, and obviously they will need to keep those for some purposes. Obviously, more and more central banks are looking at mortgages, for example, as an asset class for repo facilities with central banks. So this, in essence, would throw the light that whether banks would want to consider doing covered bonds themselves, or perhaps they could use other asset class, as I think we could see in some countries. We're talking about SME loans, we're talking about other types of loans, basically to support covered bonds as opposed to mortgages. So in countries where there are mortgage refinance corporation, I could see that the need for covered bond is a bit lesser as compared to countries which do not have the MRC's presence.
Yeah, thank you. And Colin, what do you think about the differences between those countries that haven't an MRC sort of structure and like Singapore, I guess, that don't?
Well, thanks, Richard. Well, I think, for countries that do have an MRC like Chagamas, it does provide access for financial institutions towards liquidity, both in BAU circumstances as well as in times of stress. And I think jurisdictions like Korea, Malaysia, Hong Kong, Indonesia, Thailand, they all have that intermediate step, which facilitates financial institutions or regulated entities access in terms of financing, as well as ensuring that there is a safeguard of sorts. And that is even before one actually extends and reaches to the central bank in terms of repo facilities.
Now, Director Chung touched on one topic regarding loans to small and medium-sized enterprises. And I'd like, if I can, to be a bit cheeky here and take my moderator's hat off and become a panelist myself, and just talk a little bit about Indonesia. I think because it's a country that I've been working a lot in recently with my friends at the World Bank, IFC, but also because I think it contains a lot of the issues which are relevant to some of the new jurisdictions that might be considering covered bonds. I think, like many countries, it has a vast need for funding. There's a Million Homes program that the government has launched to recognise the housing shortfall, which I thought, okay, fine, until I realised that's 1 million homes per year for over many years to make the development needs. And it's an extremely small capital markets set up there. Even on a peer comparison, the corporate debt relative to GDP is a fraction of what it is in their obvious peers in Vietnam, Philippines, let alone Thailand. So there's a very clear need for covered bonds. Is it something that foreign investors will buy? Well, yes, we can certainly get to investment grade. We've got a very nice legal framework. There's a very supportive regulator. Is it something that can help the development of the domestic market? Probably yes. But we've got two massive problems. One is the mortgage market isn't that developed, particularly when you compare it to the market for loans to small and medium-sized enterprises. And that's a very common problem in many countries. And the banks don't need the money. Particularly post-COVID, loan-to-deposit ratios are off the charts. The need for wholesale funding is extremely small. So perhaps an obvious answer is we should be looking at structured covered bonds, hopefully within a regulatory framework from the OJK, the regulator there, but by banks and using SMEs as assets. Now, we've seen this development in other countries, there's some similar developments without the framework in India, for example. But my question for Joe, it's a very long question. Question for Joe is, if it's backed by SME loans, if it's not issued by a bank, is it a real covered bond? Can it fit into your framework for covered bonds?
Thank you very much, Richard. So first of all, we do not comment on whether a product is a covered bond or not, but we will more follow the market convention. But with respect to rating methodology, I think in our European team, we did rate the kind of transaction you just mentioned, which I think Europeans are currently not backed by SME loans. And in those transactions, we use our normal rating methodologies. To talk a bit more about our rating methodologies, so generally for covered bonds, we apply our covered bond methodology to assess the due recourse nature. And on top of that, we also apply the securitization rating methodology according to the asset type. So for example, if it's a mortgage covered bond, we apply the RMBS methodology. And if it's SME loans, we apply the relevant SME securitization rating methodologies to assess the asset risk. So it's true that SME loans generally have a higher risk than residential mortgages, which, as you mentioned, are the best asset in a bank's book. But unlike the SME loan tend to perform worse during crisis, they are more concentrated and maybe not that liquid in some cases. But our rating methodology can consider whether the structural protections would mitigate the risk. For example, whether the level of OC, over-collateralization, will cover the credit risk, and whether there will be some trigger mechanism to reduce counterparty risk. So to summarize, we have certain flexibility to apply our normal methodologies for covered bonds backed by different asset types. And if the SME covered bonds include different structural protections, they could potentially achieve similar credit quality as mortgage covered bond in the same country.
But it's not a fundamentally different type, it's just a matter of different forms of credit protection to get you to the same level.
Yeah, exactly.
Yeah. And that applies, and obviously SMEs have all of those features relative to mortgage loans, but also banks versus non-bank issuers is a difficult one. Do you rate any non-bank issuers within your covered bond framework?
Yeah. So our covered bond framework applies to bank and also non-bank financial institutions. So among our global space, we do raise some covered bond issued by some building societies. So we look at whether the issuer are regulated institutions, what are the regulatory framework, so that the likelihood they will perform according to the document to manage the cover pool, etc. So our methodology apply not only banks but also financial institutions. But we do assess the regulatory framework for the issuer.
Colin, you're obviously very familiar with these arguments in a European context where we've been talking about ESNs for I don't know how many years now. Thoughts on that, and also thoughts on the equivalence rulings. The Covered Bond Directive says that by 2024 we could have equivalence. Is it really going to be this close to a European definition of covered bonds that non-banks, SME-backed bonds are going to be not within it, or is it going to be a bit more flexible on that, do you think?
Given that we've been talking about this for so long, Richard, I probably would not have an absolute response. But no, I think if you go strictly by the principles, a covered bond must exhibit a couple of characteristics. A regulated and a supervised institution is one. So I think Joe's earlier comment about being able to read both non-banks and banks is very helpful. But I think that the primary requirement and principle is that it has to be a supervised or regulated entity. And I think if that is ticked off, then it would still fall under what is defined as a covered bond. Now, that just points to the issuing entity. The question next, which is your point, is will SME loans as underlying covered pool collateral comply? And I think with the equivalence conversations and the current differentiation between covered bonds and European secured notes, there is a certain move towards ensuring that the collateral for covered bonds are restricted, and they're restricted for a reason, because covered bonds occupy a certain space under the high quality liquid asset regime under the Basel rules, and for good reason as well. So I do suspect that whilst the methodology and technology on covered dual recourse as a segregation, supervised institution, legislation, if they all come together, it could possibly be part of the European secured note type structure, but it probably will not comply with the covered bond principles, and therefore the benefits of to investors who are holding covered bonds.
I always wonder about the equivalence, how specific it is. We have all of these articles, we know the articles off by heart in the Covered Bond Directive, but there's often a room for principles. There are features like, do you need a cover pool monitor or not, or do you need 5% or not? There's always a little bit of wiggle room. But I think specifically, you've got countries like Japan, which have very well received, very, very successful covered bond programs that don't meet many of those articles, but the market seems to say it's a covered bond. Is there room for them to get into a definition?
Well, I think Japan has done everything that it can at this point to comply with what it perceives to be the principles of the covered bond market. I think one can easily call any issuance a covered bond, so long as hand on heart you get to say that it's a covered bond. But I think the Basel rules, as well as the European covered bond directive, is very prescriptive about what principles need to be adhered to in order for it to satisfy the so-called covered bond definitions. So I do think when equivalence is assessed, it may not be as prescriptive, but it should be more principles based on the pure fact that it is meant to be all encompassing, meaning that the directive and the articles that come under the directives are meant to cover as much of a global market as possible. Now, the global market is not uniform. It is diverse, and it is different in every aspect, both culturally, both economically, legally, as well as from a tax perspective. So I do think a balance between complying from a principles base, from a Basel approach as well, in terms of the prescribing the definitions of what a covered bond must be, and overlaying that with the rules of the directive, the articles of the directive.
This is maybe a little bit provocative, and I hope that I hope Luca's not watching this, because Luca's a great believer that Luca Bertolot's a great believer that the principles which have been established in Europe, the definition of covered bonds in Europe, can drive the global definition. We should be taking the directive and putting it in front of on the desks in Basel and saying this is the framework you should use. Is there a slight risk to that it's going to ignore regional concerns, regional specificities, and we should have a broader definition? I don't know who wants to have a crack at answering that.
Maybe I should have a first crack at that, Richard, before it gets before Luca wakes up.
Okay.
But I think in terms of it's always been a fine balance. It's a balance between having a global framework, one that is accepted, endorsed by both issuers and investors, and more importantly, the ecosystem includes the regulators as well, because that's where the concessions on HQLA eligible assets, LCR eligibility, maybe preferential capital treatment all come in. Now, I think if we start moving it away, and that's where I think the fine balance between having to understand that if it cannot be a position where it's, if you don't comply, the door slams shut. I think we need to be able to find a way to be as all-encompassing as possible, so that we don't leave any jurisdictions behind in terms of having a covered bond framework, by the same token preserving the pristineness of the covered bond product, so that from a regulatory perspective and from an investor perspective, there is a certain level of consistency and confidence.
Joe, is that something that you would have a view on just from a credit perspective?
So just to add on a bit, I think as Colin just mentioned, from credit perspective, I think for us, we think the most important thing is the due recourse and asset segregation. So long as the product is like have the recourse to the issuer first and then to the asset, the risk profile would be like similar to covered bond. But in case if this does not hold, like if you recourse to the asset first, then to the issuer, then I think that could view very differently compared to a covered bond. So I'm not saying commenting on whether the variation of structures should be classified as covered bond or not, but I think if this can be extended to different asset type or different variation of structure of covered bond, this would really materially help the development of other market, because that would improve the market liquidity of the covered bond, and from credit perspective, that would like reduce the refinancing risk of the covered bond, which is credit positive.
And it's something I want to get onto is the domestic demand for the assets. Now we talk about conforming to the directive and the appeal to European investors, but in the case of Indonesia, for example, it was considered this is the potential to develop local investors, making it acceptable under local liquidity rules for bank treasuries, for example. To what extent do we think that the local market development depends on the European development, or can it be independent? I don't know, in India or Indonesia, can we say we'll make our own definitions when we're thinking about better risk weighting, repo eligibility, LCR eligibility? Who wants to volunteer an answer?
Yes, it's me again, Richard. If my panelists will allow me to just have a go at this first, I think Datuk Chu mentioned earlier as well that the options for the domestic investors, one would think that with even greater security and structure, you end up being even more expensive. So if you look at in terms of development of the domestic markets, there needs to be again a development of the ecosystem, meaning there needs to be a certain level of incentives to the investors, whether they're bank investors or regulated investors, with respect to capital treatment, with respect to eligibility for HQLA. Now, if you look at Singapore, for example, if you look at the government curve, to think of an issuance that would be benchmarked and comped with the government curve, you would think then it should have the same level of treatment. Unfortunately, under the regime, it is likely that it will be still level 2A, whereas government holdings will be a level 1. And then thereafter, I guess the ability to do a compare trade-off, slowly puts a domestic covered bond a little bit less in favor. But on this point, I would also defer to Dr. Chung, because I think he's got his earlier comment probably gave a precursor to this.
Dr. Chung, would you like to comment on the treatment for ringgit investors?
Thank you. I think, as I mentioned, basically, currently there is nothing on covered bond in Malaysia. But for example, I think as Colin mentioned, in Singapore, you qualify under Class 2A. So a similar paper issued by Chagamas today, which is a senior unsecured, also qualify under Class 2A. So again here, as I said to the investors, basically there's a difference in terms of the return, in terms of the yield, definitely, because the senior unsecured definitely will be paid higher than a covered bond. So in essence, we would see that yes, in the market, a well-developed domestic capital market or fixed income market, there may be this conundrum or this what you call disagreement between what the investors will require as well as what the issuer is willing to give. So in essence, if you look at not just the cost, the yield itself, but if you look at the overall cost, because of the over collateralization and all that, technically for the issuer perspective, again, is also more expensive. The unique thing about Malaysian market today is that even, for example, Chagamas, we have both outstanding senior unsecured, we have also outstanding residential mortgage-backed securities. Our senior unsecured of a similar tenor is actually priced more competitive than the residential mortgage-backed securities. So in essence, what it means is that investors actually would look at the name of the issuer. So in essence, if you look at what a senior unsecured of Chagamas versus a covered bond, for example, again, the same principle apply for both, which is basically the recourse to the issuer first, and then if the issuer cannot fulfill the obligation, it goes to the assets. So it is quite similar in essence, I think, and that is why, as I mentioned, not just about regulatory requirement or treatment at this point in time, it is basically an alternative of each other. But I think for market development, we are willing and should look at even how we can blend in with a covered bond in the market as well. But essentially, as I said today, both looks quite similar, except legally, maybe they are slightly different. But in terms of an investor's perspective, there's actually not much difference in a sense. Thank you.
Yeah, well, thanks. From the economic perspective, yeah, I see that. Joe, you rate covered bonds in countries with large domestic investor bases and with no domestic investor base. From a rating perspective, from a credit perspective, does that matter?
Yes, thank you. So from rating perspective, the presence of a domestic market would help reducing the refinancing risk. The reason is with a buyer of covered bonds in a domestic market, in case there is a covered bond issuer is in default, there could be more potential buyer of the covered pool or together with the covered bond by other players in the domestic market or foreign market, so that the covered bond transaction can more easily raise funding to refinance the covered bond. So to us, we do look at like whether it's domestic, foreign, the market depth of covered bonds, which the higher market depth would means a lower refinancing risk, and that's captured in our rating analysis.
Right. And I would just say, Colin, it's a topic of conversation we've had in Singaporean market before about the lack of development of a domestic Singaporean dollar investor base. It would help.
Yeah, Richard. I mean, I think that is I guess a topic, and I think you mentioned it earlier as well. In terms of the domestic availability and access to loans. So the real question is a balance between what Dr. Chung has mentioned and many of the financial institutions in Asia and in their ease of access to deposits. And you know the LDR ratios are looking very, very healthy. But with that comes the overhang, which is that the access to these deposits also is typically the cheapest access to funds. So your point on economics is probably front and center, really.
Yeah. But and it's one of these things we keep coming back to is yes, you can have high loan to deposit ratios, but as Dr. Chung said at the beginning, one of the initial things was about ALM mismatches, short-term deposits, 25-year mortgages. It's a concern.
I think it's a concern, and maybe I'll look towards Joe to see how big of a concern it really is in Asia. Given I've at least on the structure and the underlying asset standpoint, the weighted average life of these assets are significantly shorter than their legal maturities. But maybe I might just throw it over to Joe. Sorry about that, but Joe.
Joe?
So just to make sure I get the question. So you're saying the underlying asset have shorter maturity compared to?
Well, just in general, the mismatch, and I guess we can consider that within the overall context of a bank that's got lots of loans which are long dated and lots of deposits which are short dated. Maybe that's a question for your bank colleagues. I don't know, but do you want to comment on that?
Yeah, I think that's more relevant for our bank colleagues. But I think for like the APAC cover bond issuer we rated typically, they are highly rated. Like for Singapore, they are AA1. So they are like easily the highest rated among the highest rated issuer in the world. So I would think this issue probably is not a like major issue. But as you said, that is more our banking colleagues' expertise rather than structural finance.
Yeah.
Richard, I guess when banks are now giving out mortgages in floating rate, for example, I think that basically that risk is somewhat mitigated because previously, obviously, from the liquidity standpoint, there's the mismatch. But in the pricing standpoint now, basically it's been hedged simply because mortgages are mainly, at least in Malaysia, they are mainly floating rates. So it's very much tied to the interest rate environment at the point in time, and with various robust asset liability management, banks are actually able to manage that risk. And the other point that I wanted to make is actually, for example, in Malaysian banks, basically the LD ratio is actually quite healthy in less than 90, maybe 80%. So in essence, there is basically this no liquidity issue as far as most of them are concerned. Thank you.
Yeah. I know, and that's one of those common objections you always get is loan to deposits are very nice at the moment. The examples I always quote are those countries which have seen very rapid expansions in their mortgage market, and the loan to deposit ratios can be very sensitive to that always. There's one other topic, we've just got a couple of minutes left. There's one other topic that I would like to talk about, and Colin, your work with the Global Issues Working Group and your work on the equivalence, is presumably most of your conversations are with fellow Singaporeans, Koreans, Australians, Canadians, all pretty well rated countries, and for them equivalence is vitally important. If you hit equivalence, your covered bonds become like fan brief effectively. To what extent, though, does it actually matter in a BB or a BBB rated country? If we're talking about bonds that are going to be maybe single A, does equivalence matter so much, do you think?
I guess if we take a step back, there are jurisdictions even in Europe which may not be as highly rated as well. So I think we first and foremost, I do believe that we've got to get the principles right from the onset. And I think moving forward, the equivalence conversation is important from an investor standpoint and a regulatory standpoint as well, because that's where many of the so-called decisions on investment treasury holdings will begin. The ability, for example, where we've assumed and presumed that many of the non-EEA jurisdiction issuers will be level 2A. Now, post equivalence 2024, if you're not given equivalence or you're not granted equivalence, you may not get that level 2A, which is status quo today. Of course, the holy grail would be if in the matter of equivalence, and therefore we might be potentially considered level 1, but that's another conversation altogether. But I think the foundation of it all is the principles of which the covered bond and the covered bond product is backed on.
Right. Joe, you speak to a lot of investors. What's your thoughts on that?
I think from risk perspective, like adopting a standard cover bond structure would be easier for investor understanding, like the global cover bond structure. There have been many analyses conducted. So in case the structure is like similar to the standardized structure, it would be easier for investor understanding. And on top of that, we also think there are many credit positive features in the directive. For example, like there is a 180-day liquidity requirement, which can help continuation of cover bond interest payment for borrowing issuer default. And that could be like quite valuable for like some lowly rated or newer market, because for those countries, it may take like longer time to take over and expose the cover pool in case of issuer is in default. So like this kind of liquidity requirement and other credit positive features in the directive could help like raise the credit standards of cover bonds.
I think things like the liquidity facility are interesting. Clearly, that's a great thing for a Eurozone bank where a bank can go wrong and the Eurozone can be fine. How does it interact with your sovereign ceilings? If your sovereign ceiling in a country is capped at a level, does the liquidity facility actually add as much value?
To pierce the local currency ceiling, so for each country we do have like local currency ceiling and foreign currency ceiling. Local currency ceiling would capture like the fundamental systemic risk associated with the country. So for that ceiling, if the liquidity or whatever support in the cover bond come from that country, probably that won't allow the cover bond to pierce the local currency ceiling under our rating methodology. So unless there is some like external support from other countries, that might help pierce the local currency ceiling.
Right. Okay. Dr. Chung, what are your thoughts on this?
Yeah, as an issuer, I think it's important for us, from our perspective, basically how many notches we can pierce in terms of our issuance of covered bond if we undertake that, especially in foreign currencies. As you know, currently Malaysia and obviously Chagamas is rated by Moody's as A3. And we were advised that basically we could pierce maybe 2 levels, at the max 4 levels, which is very unlikely, I believe. So in such scenario and for such countries, the benefit of actually availing to the European investors may be lesser compared to countries like Korea or Singapore, which can actually achieve a certain rating thereafter with the issuance of a covered bond. So perhaps that's something that's why you will see also in terms of development of covered bonds, especially into the foreign foray, that maybe countries that are not so well rated or not as rated at AA1 or AA3, at least at this point in time, may find the benefit similar to other institutions which are better rated.
Thank you. We've just got a couple of minutes left, so I'd just like to ask one completely open question, seeing as this is the last session of the day. What's the Asian covered bond market going to look like in 5 years from now? Colin, I'll nominate you to go first.
I was keeping very quiet, hoping that you would ask me this question.
Of course I'm going to.
Thanks, Richard. I think my little crystal ball, I've always said that, we would see increased levels of issuance from Asia. I think, if I use a rearview mirror as an analogy, I think we have actually seen an increase in issuance volumes, and the number of issuers have come and embraced the covered bond product and the market. And they have been all about assessing the investors in Europe in the global investor landscape. 5 years down the road, I would dare say that we would continue to see that adoption of the covered bond product, and I think with equivalence with the amount of noise surrounding the covered bond product globally, I think you would continue to see covered bonds grow, both in terms of new jurisdictions, an increase in the number of Asian issuers, and a continued increase in terms of issuance volumes. Now that's as positive as I think I could make it sound.
Joe, Colin's being very positive. You're a rating analyst. Your duty is to be a bit negative to keep us in check. What do you expect?
Actually, on this, I personally sort of agree with Colin, because given the current interest rate hikes, macroeconomic uncertainty we observe globally, there could be more incentive for APEC countries to develop covered bond market, which have been proven to be stable funding sources in Europe, even during crisis period. So we probably would be able to see a more development like domestic covered bond, structured covered bond, and perhaps for in 5 year time there could be more supportive laws or regulation for covered bond issuances in APEC. So and if EU equivalent is achieved for APEC, especially those newer and less developed market, I think that probably would even accelerate things, because that would be signaling the importance of the funding channel for APEC issuers.
Dr. Chen, more positivity, more mortgage finance companies?
I guess, like I said, in terms of development, we do hope to see the development of covered bonds in the country. But again, the debate is still there, whether with MRCs, do you really need covered bond? Is it an alternative, or it is a complement, or it is a sole instrument that need to be present? And whether that we should actually subscribe to a one-size-fits-all solution and to comply with the certain standards that's been set, or we should actually be more open in terms of what is defined or what type of asset classes that come under covered bond. But obviously for countries or for issuers that want to attract the European investors, I guess we would need to comply with the European requirements. But if it's for the domestic market, again, as I said, do you need to comply with the same standards? Or is it something that is cast in stone that cannot be varied from countries to countries? Perhaps there's a long debate that could take place in answering those questions, but I guess I would think that in the future, yes, perhaps development will take place in terms of development of covered bonds, but in what form and in what nature, whether it should follow exactly the same model as has been prescribed, is something I think I don't have the answer to. Thank you.
Well, my prediction is that 5 years from now, we're still going to be debating these topics. The nice thing is we're going to be doing it in person then. This time, well, I think in spring, we're looking forward to coming back to Singapore for the first physical Asian covered bond conference for 3 years. Before that, we will be in Vienna on Thursday, the 22nd of September for the Global Covered Bond Congress. After 2 years of missing that, that's something I'm looking forward to so much. This has been the final session in the covered bond briefings. The link that we set up to try to provide a conversation when we were in lockdown mode, it's been very effective, and I'd like to thank our sponsors on that: DZ Bank, DBS, Helleberg, NordLB, Moody's and Danske Bank for their support in this series. Thank you all. Thank you all to my panelists for today's debate, for today's discussion. Looking forward to seeing you in Vienna in September. Thank you.